Hello, everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. My guest today is Peter Cardillo, who's the Chief Market Economist at Rockwell Global Capital. Peter, thanks for coming by once again. Good to see you.
Good to be here.
So here's what I'm thinking, okay? I want to run this by you. A couple of years ago, all the talk was inflation, even hyperinflation. Everybody was looking at central bank monetary operations, the Fed, quantitative easing. All we heard was printing money, and everyone made their bets on that, and that didn't pan out. You know, we saw gold pull back. We saw a big pullback in commodities over the last 2-3 years. And now what I'm hearing is some of those very same people who were warning us about, you know, incipient inflation, hyperinflation, they're now talking about deflation. Now, when I hear something like that, when I see the crowd switch, I don't know, just my contrarian mind kicks in, and I'm thinking, they're all talking about deflation now. Maybe we should put on that inflation trade after all. What do you think about that?
I think it's too early, but eventually we will have inflation. There's no question about that. As far as deflation is concerned, Europe could be facing a sort of type Japanese deflation period. But I don't think that they're there just yet. In fact, you know, very interesting. Just the other day, the ECB had their monthly meeting, and of course, Mr. Draghi, you know, went out of his way to say, "Hey, look, guys, you know, inflation is low. It's certainly not where we would like it to be, but we're not that far apart from the American inflation rate." And so he sort of like threw ice on the fact that maybe deflation is really setting in. And I, to a certain degree, I'd have to really agree with him because, you know, as you wisely said, all the hoopla about the quantitative easing producing massive inflation never really came to fruition. And I suspect that one of the reasons for that is that we have ample amounts of crude oil, and which is obviously the key to inflation, and the fact that the Federal Reserve, managed so far to contain, the flow of quantitative easing without pumping up commodity prices. Now, sure, we had a scare in gold prices, and we saw gold prices go way up, but we never really saw the key inflationary,
which is
core oil takeoff.
So let's talk about that for a second, because that's a very interesting point that you raised, right? Oil has been stable, just around 197 on WTI, 106 on Brent. But yet, if I was going to play the devil's advocate here, and you look at those prices, which clearly have been stable. I go to fill up my car, and it's been the same price for 4 years now. But when you look around the world and you see a lot of new oil production, specifically in this country, where now we're becoming a net exporter for the first time in I don't know how long, maybe forever. Plus the fact that economic activity all over the world, I mean in Europe, in the United States, everywhere pretty much is weak. We have very high unemployment levels still. So that oil price at $100 or $95, given these what normally would be bearish fundamentals, isn't that saying something? Like there is a lot of underlying demand there.
Yeah, well, but demand, is basically paced at what the global economy is actively growing at. And so the demand factor...
But if there's a small uptick, I'm sorry for interrupting, but if there's a small uptick in economic growth, don't you think there's where your inflation kicks in? There's where your oil price rise kicks in?
I think we're a little far away from that because, as you pointed out, America is producing much more oil now than ever. We're becoming net exporters. And let's look around the globe. Where is oil really being pumped out of now that wasn't before? Africa, North Africa, even in South Africa. There are producing wells now, and Africa is becoming a major play in the oil market.
So let me ask you this: would you be short oil? Would you be away from the oil sector or defensive on the oil sector right now?
No, I would be neutral to it, and I think that eventually we will see higher oil prices, but not to the point where unless there's some political. Geopolitical problem that arises, that's a real serious threat. And you know what? That's another factor. We had that scare when we had the Arab uprising throughout North Africa, within the Middle East region, and yet we saw prices actually come down. Again, it's a function of supply and demand. And the supply is out there.
Right. Now let's talk. I want to talk a little bit about gold because I led into this discussion with this sort of contrarian view of things, and the same thing applies for me when I look at gold. That a lot of the gold bugs from several years ago, you don't hear them so much anymore, and in fact, some of them are saying now it's going down. And I mean, when I hear that, it's almost like wild horses can't hold me back from making a bet that it's going up now.
Well, I don't think it's going to really collapse like a lot of people have been forecasting. In fact, I think that we're probably going to see 1350 very shortly. I think, the fear factor of the Fed's reducing stimulants has been already placed in the market. And I believe that you should always have a 5 to 10% portfolio of gold within your portfolio. So, are we going to 2,000 anytime soon? No. Are we going to 800 anytime soon? No. I think we're just going to stay in a trading range until we get some evidence of inflation. So, certainly quantitative easing, has not really been all that negative for the price of gold, but certainly not all that positive because it hasn't produced inflation.
Well, I think it was more negative than positive. I mean,
only because
the initial run-up, everyone stampeded into it, and then when nothing happened, it was this slow leak which eventually precipitated into a crash.
Well, you want to call it a crash. I want to call it a correction. What we were down 575, 600 points from the high level.
But that's not,
but we're also up from 1980, from 1981. We also came up from a low of 250. So if you take 250, put the present price today, which is what, 1260, 1258 right now, percentage-wise, the price of gold has steadily gone up.
That's the nominal price. You have to adjust for inflation. But let's talk a little bit about, you mentioned the pulling back the stimulus. I never viewed quantitative easing as stimulus at all. I mean, I was, a minority out there for sure, but I think I was proven right in that the QE removed so much interest income from the economy. The Fed was buying all these securities that stripped away that interest income that would have flowed into the economy, and we could see it very clearly. Now, this reversal of QE is the opposite. It leaves that income in place, okay? And so I think they're getting it wrong again. I think that when they're looking at this saying this is a removal of stimulus, it's actually a removal of fiscal drag. It allows that fiscal injection to stay in the economy as opposed to the Fed taking it out. Don't you think?
Well, that you're right, but the problem lies is when the time comes that they have to reverse their balance sheet, and that's when.
But all that is a rise in interest rates, and that again is what I'm saying. If you raise interest rates, and if the government is a net payer of interest, which it is, it raises the fiscal injection into the economy. The government's paying more interest into the economy. It lifts the income level. So it's not, it doesn't slow things down. I see it as speeding it up.
Oh, I'm not suggesting that it's going to slow things down, just the contrary. What I am suggesting, it could cause a bit more inflation.
Ah, there you go. Well, we agree on that. All right, so let's just sum it up. Your view for this year, 2014. How do you see things playing out?
Okay, I see the economy growing at 3%, possibly even 3.25%. I see the labor market producing anywhere from 200 to 250,000 new jobs, even though the past 2 months it hasn't panned out that way. But there were special factors in there, seasonal factors, and above all, the weather factor. In fact, if you looked at last week's unemployment rate dropping down to 6.6, for this time, it meant something because the participation rate actually went up a bit. So that's good news. That's not bad news. And I think, that inflation probably will stay pretty much under what the Fed is looking for. But again, a lot depends on what happens with the geopolitical situation. Again, probably nothing much in the Middle East. If anything, it could actually improve.
Yeah, it looks pretty calm right now.
So I'm looking for a good year in terms of economic activity. I think Europe will continue to pull out of its recession. In fact, it's out of recession. But I think that you'll see growth beginning to pull up throughout the European continent.
All right, sounds good. Pretty upbeat. Thanks very much.
My pleasure.
That's it for now, folks. This is Mike Norman saying see you next time. Bye-bye.